Hello and welcome. In today's session, you're going to practice the Personal Tax Financial Act 2023. So if you are doing your exam for 2024 and till January 2025, that will be the right revision for you. So you're going to practice all the questions we have. So starting from the employment income, and we'll keep revising until we do inheritance tax. So you're going to practice employment income, property income, capital gain tax, every single question that cover from the syllabus. So I can definitely tell you, if you practice all this question, you will definitely get a good score in the exam. So we'll start from the employment income, we'll start from all the income tax liability, and every single thing we have I try to explain in detail. Hopefully this will be very helpful for your revision and will definitely do well in the exam. So let's start with our revision today. All right, so we're going to start with our personal tax. The first question we have here that is relevant to the different type of income. Now we have a different type of income. It's very important to identify the right income. For example, it is possible we can have a savings income, we can have a non-savings income, we can have a dividend. So definitely if you already revise your book, you already know how does it work. Here we're just going to do the revision. I'm not going to go in detail what we have learned from the book, but we're going to learn exactly how to solve every single question we're going to see today's session. So let's start with the first one. So the first one, it says for each of the following source of income, indicate whether it is non-saving, it is a saving, or it is a dividend. So you just need to identify that. Quite straightforward. So first one, we have a trading income. The trading income is always non-saving income. So that's non-saving income. Then you have a dividend from a company. Dividend is always dividend. Then property income, again, is a non-saving income. Building society interest is a savings income. Then you have a bank interest. Again, it's a savings income. Pension is a non-saving income. Employment income, again, is a non-saving income, and interest from the government guild is a saving income. So sometimes some students, they think like pension is not a taxable income. This is not true. Remember that pension is a taxable income and it is a non-saving income. All right, so the next one we have here, question number 2, it says in 2023-24, Gavin received pension income 19,300. Bank interest 2,000 and dividend 5,400, and the lottery winning 6,000. So Gavin net income represent the total income, and this is very simple. So we have a non-saving income, that is pension, 19,300. We have a bank interest, that is saving income, 2,000, and we have a dividend income, 5,400. So all you have to do, you have to add these three to find how much is the total income, and that will be 26,700. Remember that we're not going to consider the lottery winning or gambling or winning the scholarship. This sort of income or this sort of earning is exempted from the tax, so it is not taxable income, so we do not consider that. So we said 26,700. Then the next question here asking the personal allowance that Gavin is entitled to. How much is the personal allowance he is entitled to? Now, of course, the personal allowance have a restriction if someone income is more than 100,000. So 100,000 is the threshold. So if someone net income is more than 100,000, for every £2, 1 pound personal allowance will be reduced. So now here his income is only 26,700. That is definitely less than 100,000, so you don't have to worry about that. So he is entitled to have a full personal allowance, that is 12,570. So 12,570. So he is entitled for the full personal allowance. All right, let's move to the next one. The next one we have here, question number 3. So let's have a look at that. It says Mr. B has the following income. Salary is a non-saving income, we know that. Then we have interest received, amount received and shown. National Westminster Bank, so that's the interest, that is a saving income, 457, so saving income. Then we have a ISA. Remember that ISA is always exempted. Do not take the ISA. ISA income is exempted, so exempted. And the Nationwide Building Society, 400, this is also savings income. So it says, using the pro forma layout provided, prepare a schedule of income clearly showing the distinction between the non-saving saving income. If income is exempted, enter 0. Okay, so for the ISA, we're going to enter 0. So earnings, we're going to write the salary 15,000, that is non-saving, so 15,665. Then we have the building deposit interest, and that is savings income 457. Then building society interest, that is 400. Then we have an ISA, we need to enter 0. This is a exempted income, so any exempted income they said enter 0, so we follow that. Then we have a net income, so we need to just make a total of that. So here we have a 15,665, so 15,665. Here we have 857, and the total is 16,522. And from here we need to minus our personal allowance. The personal allowance is 12,570, and we always deduct from the non-saving first. So 12,570 we minus from the non-saving, because with the savings and the dividend we have some allowance, but with the non-saving we don't have any allowance. So for that reason we always minus the personal allowance from the non-savings income first. So if we deduct the personal allowance, we have a net income for the non-saving, that is 3095, and here we have the full amount 857, and the total is 3952. Remember that when we have a income total, we called it net income, and from the net income, when we take away the personal allowance, we call it taxable income. And from the taxable income, if we minus the PAYE or the tax deducted at source, we called it tax payable. So you need to be very careful with that. In the exam, if you see the question give it to you the taxable income, then do not minus the personal allowance again. If the question give you the net income, then you use the personal allowance. Otherwise, ignore the personal allowance. You have to be very careful in the exam. Alright, that's not very difficult. So let's move to the next one. The next one we have here, question number 4. Alright, so the question number 4 is asking to find it out few questions. So let's little bit smaller. Actually 5 is bigger, not 4. So let's try the 4 first. It says Max has net income 116, so that is more than 100,000. If you see the income more than 100,000, you have to stop, because you need to make the adjustment for the personal allowance. He made a gift, a donation 4,000 gross. Remember that if there is a PPC, that is called a personal pension contribution, or the gift 8, that will always extend the band. So it will extend the basic band, also it will extend the higher band. Anyway, so let's have a look. Maximum personal allowance, so how much personal allowance he will be entitled. So let's have a look. The net income, the question said 116. So net income 116,000, and from here we need to minus the gifted donation. So gift 8, 4,000. If the question give us net, not gross, for example, if the question said net 4,000, we need to gross it up by 20%. Remember that we always minus the gross. So minus the gross to find the adjusted net income. So that is 112. And we called it ANI, adjusted net income. And from the adjusted net income, we minus our personal allowance threshold. So personal allowance threshold, and that is 100,000. This is always fixed, 100,000. So we have excess of 12,000. And for this 12,000, half of the personal allowance will be reduced, because for every £2, £1 will be reduced. So we need to divide by 2, and that's 6,000. So personal allowance will be reduced by 6,000. So normally my personal allowance is 12,570, and from 12,570 I need to minus the 6,000 to find how much is my personal allowance left to claim. So it will be 6570. So 6570. That's quite straightforward. Alright, the next one we have here, the maximum amount. Question number 5, the maximum an individual can invest for the tax year in ISA. So how much a person can invest in the individual savings account, that is 20,000 is fixed. For tax year 23-24, it is 20,000. So maximum someone can invest in the ISA, and ISA is exempted and interest to receive. So that is maximum 20,000. All right, let's move to the next one. Question number 6, we have a little bit more calculation. So let's have a look. So here we have Alison has the following taxable income for 23-24. Okay, so we have a different type of income. So you can see non-saving income, it is 145,280, and the saving income is 15,000. So that's the total for non-saving and for saving. Alison has already paid 50,000 in PAY. That means the tax already paid at source, that is 50,000. If the question asks you how much tax still you need to pay, remember that we have to minus this 50,000 because it's already deducted at source. Alison personal allowance is how much personal allowance he is entitled. Now look at this income. Non-saving is more than 145, and we have a savings as well. And we know if the net income total, net income, if it is more than 125,140 or more, then we lose the personal allowance. There is no more personal allowance available if someone have a net income more than 125,140. So his income or her income here is more than that, because if we added this to, it's definitely more than 125,140. So there is no personal allowance left for her. So we say 0. No personal allowance left for her. The next one says tax on the non-saving income at 20%. Now we have a different threshold, of course, because we need to look at the band. So here we have a non-saving income 145,000. So 145,280. We need to break it down into different threshold, because up to 125,140, that is the higher limit, and we have a basic band that is 37,700. So if we have the non-saving income that, so we need to find up to 37,700, the rate will be 20% always. This is my basic band. But if Alison made any contribution to the personal pension scheme or the gifted donation, this band will be extended. Remember that. And from this to 125,140, this difference between 101.25, 101.25,140, this amount will be always 40%. That's the higher band. So let's find it out. 125,140 minus 37,700, and this difference is 87,440 So in this amount we will pay higher tax, that is 40%. And if we have income more than 125, 140, then we need to pay the additional rate tax, that is 45%. So if we added this to this is 125, 140, and the rest of the balance, that is 145, 280 minus 37, 700 minus 87, 440, and the difference we have, that is 20,140, and in this amount 20,140 we have to pay the tax 45%. That's the additional rate. So we have 20% here, and that is 7,540. 40% on the higher band, 34,976, and the additional rate 9,063. And if we added all of this thing, that will be the total tax liability. And we need to make sure we need to do the savings as well, that for the non-saving. So saving we have 15,000. So 15,000 is the saving, and he is a additional rate taxpayer, so he will not have any allowance. So we're not going to get any allowance for the additional rate taxpayer. If someone is a basic rate taxpayer, the allowance is 1,000. If someone is a higher rate taxpayer, the allowance is 500. For additional rate, we don't have any allowance. So on this 15,000, the tax will be 45% on additional rate, and that will be 6,750. And if we added all this thing together, that will be the total tax. So 7,540 plus 34,976, then plus 9,063 plus 6,750. That gives me 58,329. That's the total tax liability. And from here we need to minus any tax already paid. This is PAYE, 50,000. So 50,000 already paid. The difference here we have 8,329. This will be my tax liability. Alright, so non-saving at 20%. So we have non-saving at 20%. So this is 7,540, 7,540. 40%, 34,970. So 34,970. 45%, 9,063. Then saving 45%, 6,750. Total tax liability 58,329. The tax already paid 50,000, and tax payable 8,329. That's it. This is a very nice calculation, because this sort of calculation will help us a lot to understand the question better way. Alright, let's move to the next one. The next one we have tax 7. Let's try that. So John, total income for the tax year 23-24, non-saving, saving and dividends. We have a dividend now. Employment income 90,000, property income 4. Then we have a building society income, that is saving 2,400, and the dividend we have 20,000. So total 94, non-saving, saving 2,500, and the dividend 20,000. Then he paid PAYE, the tax deducted at source, 27,000, and she make a personal pension. So it's she make a personal pension contribution 8,000 as well. Now remember that the PPC normally paid on net. So if someone paid PPC on net, we need to make it a gross. It's very important to remember that. If it is a occupational pension, then remember it is always paid on gross. But if it is a PPC, personal pension contribution, it is always paid on net. That means 8,000 is a net figure and we have to gross it up by 20%. So 8,000 divided 0.80, that will make us 10,000. Okay, so we have some question here. So we have a personal allowance, non-saving, saving, dividend, total tax, PAYE, and the tax payable. Okay, so let's try to do it. The first thing we'll do, we will break it down the way we always do. We need to break it down that. So let's do that. So start with this one, 94,000, non-saving, then saving 2,500, and then finally dividend. Okay, so let's see if we have any personal allowance. So the total income, we have a 94 plus 2,500 plus 20,000, and that will tell us how much personal allowance I can get. So my net income here is 94,000 plus 2,500 plus 20,000. That gives me 116,500. And as he makes some contribution on the PPC, and this 8,000 we need to gross it up by 0.80, and it will be 10,000. So this 10,000 will be extended the basic band. At the same time, it will reduce the net income. So right now the net income is 116, and we have to reduce by PPC by 10,000. So PPC, and that will make us my adjusted net income 106,500. ANI, adjusted net income. And from here I need to adjust my personal allowance threshold. So personal allowance threshold, that is always 100,000. If we minus that, we have a 6,500. So 6,500, and for every £2, £1 will be reduced. So divide by 2. So 6,500 divided by 2, that's 3250. 3250. So this 3250 will be reduced from my total personal allowance. So normally my personal allowance is 12,570. I have to minus 3250, and that will give me the remaining personal allowance 9,320. So this is my personal allowance. Okay, then we have to see how much will be the tax. So let's find it out, the tax. All right, so here when you have a income, of course, like this personal allowance will be deducted from the non-saving first, because we have a 94,000, and from the 94 I'm going to minus my personal allowance, that is 9,320. As I mentioned before, the personal allowance always need to be deducted from the non-saving income first, because we don't have any allowance on the non-saving. So if you minus that, now my non-savings income will be 84,680, and the saving remains same, 2,500, and the dividend remains same, 20,000. Now let's find out the tax, how much the tax we need to pay. Calculation of the tax will be same for the question you have done before. So we need to find it out how much will be the basic and higher band. But here the only difference, he make the PPC 8,000, so 10,000, the basic band will be extended, also the higher band will be extended. So normally my basic band is 37,700. Now it will be 10,000 more because of the PPC, so it will be 47,700. So in this amount I'm going to pay 20%. So multiply 20%, and that will give me 9540. So this is my first tax on the basic band at the rate of 20%, and not 37,700 but 47,700. Then I do the rest of the amount. So we had 84. From 84, if you minus 47,700, we still have some left income from the non-saving, and that is 36,980. 36,980. And in this amount we're going to pay 40%. So we say 36,980 multiply 40%, and that will give us 14,792. So this is my total tax liability from the non-saving. Now I'll go to the saving. So on the saving, I will have, I'm a higher rate taxpayer because my total net income is 106,000. So of course, like I'm a higher rate taxpayer. So if I'm a higher rate taxpayer, if my income is less than 125,140, I will have a saving allowance that is 500. So the first 500 I'm not going to pay any tax. So out of 2,500, the first 500 will be no tax. This is zero rated. The rest of the 2,000 will be 45% with the 40% with the higher rate, because we are a higher rate taxpayer. So that will give us 800. And the dividend, remember that the dividend don't have any band threshold. The dividend always have first 1,000 is a tax free, regardless how much is the income. The dividend first 1,000 will be tax free. So here I have 20,000. So the first 1,000 will be 0%, and rest of the 19,000 will be on the higher rate, that is 33.75. 33.75%, and that will give us 6,413. All right, now if we added all the tax, the non-saving, then the saving, and the dividend, if we added all these three tax, my total tax will be 31,545. And from here we need to minus how much is already paid. PAYE 27,000. So 27,000, and that gave me the remaining tax payable 4,545. That's it. All right, so let's move on to the next one. We just need to write everything on the box. So we have the next one, question number 8. It says Keaton has the following taxable income. Taxable income, that means this is after the personal allowance. So Keaton has the following taxable income: 2324, non-saving 33,000, saving 4850, and the dividend 1,000. So you understand the dividend will be tax free because you don't have to pay any tax on the dividend on the 1,000 anyway. So this one will be 0%. So the first one, it says tax liability on the non-saving income. So 33, and we can understand is his net income is 33 plus 4850 plus 1,000. Let's find it out. How much is the net income? So 33,000 plus 4850 plus 1,000. So 38,850. So he's just like a little bit above of the basic threshold. That means my basic threshold is 37,700. Up to there I pay the basic rate, and anything more than that I have to pay the higher rate. So if I minus my basic threshold, that is 37,700, so minus 37,700, And I can see on 1150 I need to pay tax on higher rate. Now we need to see this 11,000 fall on which category. Okay, so let's try to do it. So the first 33,000, this one on the basic rate because I'm still under 37,700. So 33,000 multiplied 20%, and that gives me 6,600. Then the next one, we have a 4850 saving. As I'm a high rate taxpayer, because 38 I cross 37, if I'm high rate taxpayer, then my allowance for the savings is 500. So for the first 500 from 4850, don't pay any tax, is zero rated, and rest of that up to 37,700. So now how much I have here? 33,500. So 33,500. I need to minus from 37,700 to see how much is the basic band remaining. So I have 4,200 left, and still I'll pay here 20%, and that will give me 840. And anything remaining for the saving, that will be on the higher rate. So I still have 150. So 150, because if I added these three, that will be equal to 4850. So break it down into 500, 4,200, and 150, because 500 is the tax free allowance, 4,200 is the basic, and as it is crossing 37,700 when I'm in 4,200, so rest of the 150 will be the higher rate, that is 40%, and that is 60. And the dividend 1000 will be tax free anyway, multiply 0%, so no tax. And that's it. So it says tax liability on the non-saving, so that will be 6,600. The saving will be 840 plus 60, so 900, and the dividend is 0. That's it. All right, let's move to the next one. The next one, it says Friendster earn 60,000 a year, that's the salary, and he pay 5,000 into an occupational pension scheme and 6,000 into the personal pension scheme. This question is very common in the exam. Remember that when he pay to the occupational pension scheme, this is the amount paid gross. So that means this amount will reduce the non-saving income. So this amount will be deducted from the salary, deduct from his earning. So from his earning, this amount will be deducted, 5,000. But this one, the 6,000 with the personal pension scheme, this one is a net. That means you have to gross it up. So if there is a 6,000, we need to divide by 0.80. So 6,000 divided 0.80, and that is 7,500 is the gross. And that will extend the band, the basic band and the higher band. Alright, so we'll say non-saving income, that is because of the occupational pension, 5,000 will be reduced. So his non-saving income will be reduced by 5. Basic band will extend by 75. So I think it's more likely this one. So his non-saving income reduced by 5,000, and his basic band will be extended by 7,500. That's the one. This question is very common in different way in the exam, so make sure you revise well. Alright, let's move to the next one. The next one we have here, question number 9. Let's try that. It says H has the following total income, 2324. We have a non-saving saving dividend, that's the total income, and his tax payable. So need to see how much is the total income. If we add in this 3, that will tell us how much is the total income. So if we do 12,970 plus 10,000 plus 70,000, and that gives me 92,970. So this is the total income. Now if this is a total income or net income, this is under 125,140. That means I'm a still high rate taxpayer. I'm not additional rate, and my income is less than 100,000. That means I'm entitled to have full personal allowance. So this is the first thing we need to do it to understand am I eligible for the personal allowance or not. Now we can do the calculation. So we need to minus the personal allowance from here to find it out how much is the non-saving left. So we go to minus 12,570 from the non-saving. So 12,970 minus 12,570, that's 400. We have a saving, non-saving, and the saving is 10 and dividend is 70. So let's do that. The first 400, I'll pay the basic rate tax. This is 20%. So that will be 80. Then I'm a higher rate taxpayer, so I'll have some allowance for the base savings. It will be 500. So for the first 500, I'm not going to pay any tax. So 500, 0%, so 0. Rest of the 9,500 multiply 20% because I'm still on the basic band up to 37,700. So 9,500 multiply 20%, that 1,900. Then I have a dividend. Dividend is always free, first 1,000. So first 1,000 I'm not going to pay anything, 0%. I need to see how much band for the basic I have left over from 37,700. So 37,700. I need to minus all this to find it out how much is the remaining balance we have. So we have 37,700 minus 400 minus 500 minus 10,000 minus 1,000, 26,300. So let's do once again. 37,700 minus 400 minus 10,000 minus 1,000. So 26,300. And you have to multiply by 8.75%. That's the basic rate for the dividend. The basic rate for the dividend, and that will give us 2301. 2301. So from the dividend we have used this amount. The dividend was 70,000, and if we minus this to 1,000 and 26,300, so this is 27,300. So I need to see how much we have left for the dividend. So 70,000 minus 27,300, that gives me 42,700, and that falls on the higher rate. So 42,700 multiply the higher dividend rate is 33.75, and that is 14,411. And from there we need to see is there any tax already paid. So the PAYE paid 300, so minus the PAYE 300. Then we'll see how much tax is payable. So tax payable 18,392, and that's it. All right, let's move to the next one. The next one we have for the question number 10. Question number 10 is asking for the income tax liability and tax payable. Okay, so let's do that. So we have a salary 48 and tax deducted 48 and the salary is 155. This is the non-saving, so let's do that. 155, and then we have interest on a bank deposit 3000, so this one is saving, so saving. And the dividend, we have UK dividend 7,000, so 7,000, and then we have a PPC, personal pension contribution, so we need to gross it up. Remember that if it is 8,000, it will be always 10,000, so 10,000, the basic and the higher band will be extended. Alright, so let's find it out. So 155,000, 3,000 and 7,000, and if we add it, 165. Now we need to look at the personal allowance, and we can see the net income is more than 125,140. So of course, like, there will be no personal allowance left, so the personal allowance will be 0. So my taxable income and the net income will be same. So 155,000, 3,000, 7,000 and 165. That's it. Now we are going to calculate the tax liability. Now when you calculate the tax liability, we need to do some workings, of course, so let's try to do it. The first one, it says income tax liability, so you're going to calculate the income tax liability. So you calculate the basic and the higher and the additional. So you need to remember the basic band has to be extended. So normally the basic band is 37,700, but 10,000 will be added. So we're going to say 47,700 multiply 20%. And that will give us 47,700 multiply 20%. That will give us 9540. 9540. So this is my first non-saving from here, 155. Then we're going to look at how much is the left we have from the higher threshold. So my higher band, normally it is 125, but of course as the basic band extended, so we need to make sure we give the higher band as well extended. So it will be 125, 140 plus 10,000. So it will be 135, 140. And from here we need to minus 47 that we already calculated. 4770. And in this amount we're going to find our 40%. So 135, 140 minus 47,700, that is 87,440 multiply 40%, and that gives me 34,976. 34,976. Now you can see here, so we have already saved some tax because of the PPC. In the exam, there is a very common question can come and then ask you like, how much is the tax savings because of the PPC? Remember that the pension contribution always saves some tax, So there is two type of tax we save. If the taxpayer is a basic band taxpayer, then he save 2000 on the tax, and also like the 2000 on deducted at source. So we have a tax saving. For example, he just contributing 8000, but actually we're claiming 10,000. So 2000 save at source, and if he's a high rate taxpayer, so up to 37,700, he don't get any advantage for the tax because he paid 20% anyway. But if the income is more than 37,700, so anything he earned, the basic band will be extended by this amount, so he pay less tax. So again, he saves some money. So you need to understand this concept. Anyway, so we have the tax here. So we have 34,976. Then we have a non-savings remaining. So now we have 47 and 87. Now our total non-savings income was 155. So let's find it out. So 155 minus 47,700 minus 87,440, and that gives us 19,860, and this one will be the additional rate because it's more than higher rate, 45%, and that will be 8937. So if we added this 3, it will be exactly 155,000. That's my non-saving. Now I'll move to the savings income. The savings income definitely go to the higher rate because by non-saving we already touch higher rate. So saving income we don't have to give any allowance because we know we are more than 155 now. So that means we are more than 125, 140. So there is no allowance for that. So you go straight away 3,000, 45%, and that is give me 1350. Finally have a dividend 7,000. So 7,000. So 1,000 will be free, 0%, and the 6,000 will be the additional rate, that is 39.35%. And that will be 2361. That's it. So if we added all of these taxes, that will be total 57,164. And minus how much tax you already paid. So we already paid 48,000. And the tax payable is 9164. So there's the tax payable 9164. That's all we have to do for this question, and they're asking for all liability and tax payable. So you can see it's not very difficult. We have to be very careful with the pension contribution because the basic band and the higher band both will be extended. And also it will reduce the net income if there is implication of the personal allowance. Alright, so let's move on to the next one. So the next one will move to our next topic, and here we're going to look at the next chapter we have, that for the employment income. So here we can look at few questions for the employment. The first one is says Peter undertakes some work for XYZ PLC. Which of the following factors will indicate that he either has a contract of service with the XYZ PLC or a contract for the service? Now contract of service means his employment, and contract for service means his self-employment. Remember that if someone is employee, then he is entitled for all the statutory benefit, for example holiday, maternity, paternity, sick pay, anything that is paid by statutory payment to the employee, he will be entitled for that. But if someone is self-employed, he will be not entitled to get any statutory benefits, so he will not get holiday. He need to use his own tools when he'll be working, and if he does something wrong, he will be personally liable for that. But for the employee, they don't have any personal liability. Even if they made a mistake in the workplace, he don't have to pay from his own pocket. Alright, the first one, it says Peter is entitled to paid holiday. Paid holiday is always relevant to the employment, not self-employment. So is employee. Peter hired his own helper. If it is the case, then it is self-employment, because on the self-employed you have to bring your own tools like computer. If you need to work something, you need to bring your own tools, and you need to have your own employee if you need. Peter takes substantial financial risk when undertaking work for XYZ Limited. So again, if you take the risk, you are self-employed. Peter does not have to rectify a mistake in his work at his own expense. That's employment. So if you made a mistake, you don't have to rectify by yourself, or you don't have to pay by yourself. That's the employment. All right, let's move to the next one. The next one we have here is says this question is for the car benefit. So Emma was provided with a petrol engine car by her employer on 6th August 2023. So 6th August. The car cost the employer $13.50 and the list price was $15. Remember that we always take the list price. Always consider the list price. Do not consider the cost for the employer. So do not consider that, and do not consider any discount. Always ignore the discount. If the employer get any discount, ignore that. Always take the list price. The car CO2 emission were 146. So 146 means 145, because we always round it down. The cost of the car in the taxable benefit computation is, so how much cost are you going to consider? 15,000. Do not take the 13,500. The percentage used in the taxable benefit computation. What percentage are you going to do? So let's do that. So we have 145 gram, 145 minus 55. Because for the 55 we always take 16%. That's the basic. So 145 minus 55, this is 90 gram. And for every 5, 1% will be increased. So 90 divided by 5. And that will give us 18. So 18% plus 16%, that will give us 34%. So 34%. If it is a diesel engine car, then 4% will be added, but maximum 37%. Remember that. The taxable benefit on the provision of the car is, so how much will be the taxable benefit? So you need to see how many months the employee used the car from August. So August, September, October, November, December, January, February, March, 8 months. So 6th August to March 24, 8 months. So we said 15,000 is the list price, multiply 34%, then multiply 8, divide 12. And that will give me 3,400. List price, multiply the percentage, and then for how many months. Alright. The next one we have here is says Frank was provided with a brand new diesel car. As soon as you see the diesel, remember that 4% will be extra. But if the car meet the RD2 standard, then it will be like a petrol. List price is 25,000 on 6 June 2023. The firm paid for all the fuel without requiring payment paid by the Frank. Remember that the fuel is always fixed. So you calculate the fuel benefit on 27,800 on the fixed amount, and regardless if the employee paid anything for the fuel, we're not going to deduct the fuel benefit. Remember that even the fuel benefit is 2,000, but if the employee paid 1,000, we do not deduct it. Still, the taxable benefit for the fuel is 2,000. However, he was required to pay the firm 3,500 per month for the private use of the car itself. So for the car, if the employee pay anything, we can deduct this amount, but we have a maximum limit. The maximum limit is 5,000. And also if there is accessories, for example, when the car is brand new, and if there is accessories, then we can take, but it has to be at least £100. But remember that do not take the repair and maintenance. Do not consider that. The car have a CO2 emission 117. 117 means 115. The car does not meet the RD2 standard. That means for the diesel car we need to add 4% more. Okay, the taxable benefit on the provision of the car. How much is the taxable benefit? So let's try to calculate that. So first we need to calculate the percentage. So 115. So we said 115 minus 55. Always 55, because for the 55 always take 16. So 115 minus 55, that give me 60, and divide by 5. For every 5, 1% will be increased. That gives me 12. So 12 plus 16, so 16% plus 12%, and also 4% will be for the diesel, and that will give me 32%. Remember that if it is more than 37, you have to stop at 37. Either petrol or diesel car, doesn't matter. 37 is the maximum benefit we can charge. Okay, so then the next one you have to calculate that. So you have a list price. The list price is 25,000, and in this 25,000 I'm going to calculate 32%, and then I'm going to see how many months. So we give the car to the employee from June, 6th of June. So June, July, August, September, October, November, December, January, February, March, 10 months. So June to March, 10 months. So multiply by 10, divide by 12. And that gives me 6,667. And from here we need to minus the employer contribution. Employee contribution, how much employee paid. So employee paid £35 per month. So 35 multiplied 10 months. That is 350. We minus that. So the car benefit will be 6317. 6317. The fuel benefit is quite straightforward. So we need to do 27,800 multiply 32%. We use the same car benefit percentage, and then we do for 10 months. Multiply by 10, divide by 12. That will give us 7413. All right. Let's move to the next one. The next one we have here, question number 3. Let's try that. So on 6th of April 2023, an employer made a loan 60,000 to an employee. The employee repaid 40,000 on 6th of December 23. The remaining 20,000 outstanding at 5th of April 24. Interest paid during the year 750. The official rate of interest was 2.25% throughout the 23 and 24. Okay, so this is for the loan. So let's have a look. The loan you have to calculate it two methods. One is the average method, and one is the strict method, or we call month by month basis method, and you have to pick the lower one. So let's do the first one, the average method. It's quite simple. We need to see how much was the total loan and how much is remaining. So 60,000 was the loan total taken, and 20,000 is still remaining, and then we divide by 2 because it's the average, and then we multiply 2.25%. That's the official rate of interest. It will be given in the exam. Even if it's not given, you still have to follow that. So that will give us 900, and from 900, if employee already paid anything, we have to minus that. So 750 already paid. So interest paid 750. So 150 is the taxable benefit for the loan. The next one we have the alternative method. So this one we have to do month by month basis. So 60,000 was taken and repaid 40,000 on 6th of December. That means from April to December 60,000 was used, and after December only use 20,000 till April. So you do the calculation for 60,000, how many months use? So 60,000 we use for 8 months. So April, May, June, July, August, September, October, November, December. So we have 6th of December. We cannot take the whole December. So November, so it's 10 months. So we'll take 8 months. April, May, June, July, August, September, October, November, 8 months. So we'll take 8 months. So 60,000 multiply 2.25% multiply by 8 and divide by 12, and that will give me 900. And the rest of the 20,000 I use 4 months. 2.25% multiply 4 divide 12, and that gives me 150. So this is 1050, and then I'm going to minus how much interest paid. So interest paid 750, and that gives me 300. And between these two, you're going to pick the lower one. So you're going to pick 150. Alright, the next one we have here, it says Rita, a fashion designer for Darling Design Limited, was relocated from London to Manchester 6th of April 23. Her annual salary 48,000. She was reimbursed relevant relocation expenditure of 12,000. Remember that relocation expenditure is exempted up to 8,000. So if it is more than 8,000 a year, the remaining balance will be taxable benefit. She was immediately provided with a house with annual value of 4,000, for which her employer paid annual rent 3,500. So between the annual value and the rent paid, between these two, we need to pick the higher one, the bigger one. So you always have to pick the bigger one. So here the bigger one is 4,000. Rita's employer provided ancillary service for the house in the tax year. So the company also paid for the electricity, for the gas, for the water. Remember that if company paid all of this thing, we need to consider everything as a benefit, unless the job is relevant to the work. For example, if Rita is a security guard, or if Rita is a prime minister, or work in a pub, then the calculation will be a little bit different. So it will be the lower of the earning, or lower of a threshold. So here the job is not relevant. It's not relevant job for Rita for the work, so it is not work related job. So here it's not work related job. It's not like accommodation is not work related. Some of the job you need the accommodation. For example, if someone is a security guard, he definitely need a place to stay. So this is not the case. So every single thing paid by the employer, it will be part of the benefit for Rita. Then it says that the house has been furnished by Darling Design Limited immediately prior to Rita occupation at a cost of 30,000. On 6 October 2023, Rita brought all the furniture from DDL for 20,000 when it was market value 25,000. Now here there is two things we have to be careful. The first one here is, first Rita was using the furniture for how long we need to check. So on 6th October, so that means the day he moved to the house, from that day till 6th of October, he was using the furniture, and the furniture cost was 30,000. And on 6th of October, he decided to buy the furniture from the company, and he paid 20,000 for that. But that time the market value was 25,000. So we need to do two calculations for that. Then DDL had made an interest-free loan to Rita 10,000. No part of the loan has been repaid. Assume the official rate is 2.25%. Remember that if the loan was given to the employee, either interest free or doesn't matter, if the loan is up to 10,000 or less, it will be exempted. So there will be no taxable benefit. It is exempted. If it is more than 10,000, for example, if it is 11,000, then the whole amount will be taxable. Whole amount, not only the 1,000, like 11 minus 10 doesn't work. So if the loan is made to the employee more than 10,000, the whole amount will be the taxable benefit for the employee. Alright, so the taxable benefit arising the accommodation, then the taxable benefit, the relocation. Relocation is quite simple because the company is paying 12,000 and 8,000 is exempted for a year, so 4,000 will be the taxable benefit. And for the loan, this is 0, so up to 10,000 no benefit created. So we need to look at the accommodation. Let's do that. Accommodation is the tricky one. It will be always in the exam, one question from the accommodation. Okay, so let's take a look. So the taxable benefit for the accommodation, the first thing we need to take the higher of the rent and the annual value. We'll take the annual value here 4,000 because it is bigger than 3,500. So let's take that. So we said annual value 4,000, then all the expense paid by the employer, so electricity 700, then gas 1,200, water 500, council tax 1,300, property repair 3,500. So anything paid by the employer, we have to take everything. And then we have to see the furniture. So furniture, he was given from April, so April to October. So April, May, June, July, August, September, October. So up to October, she used all of this furniture. So we need to calculate the 6 month. So from April, 6 April to 6th of October. So it take like 6th of May, June, July, August, September, October, 6 month. So 6 April to 6 October, 6 month she used the furniture. So the cost was 30,000 and the benefit is fixed, always 20%, multiplied by 6 divided by 12 for 6 months. So that will be 3,000. Now the rest of the calculation is a little bit tricky when she buy the furniture. Now when the employee received the furniture as a gift or either the employee purchased, we have to find the higher of or greater of between the market value and the carrying value. In this case, the market value was 25,000 and the carrying value means the cost minus value assessed. Cost minus value assessed. So cost was 30,000. The value assessed means how much is like already depreciated. So she already used for 3,000 pounds. So we need to minus the 3,000. So the value is gone down by 3,000. So it is 27,000. So between 27 and 30, we need to pick the higher one. So higher one is 27. So we need to pick the higher one. And from here, we need to see how much she paid. So she paid 20. So something, the asset value was 27, but she paid 20. So she get a benefit of 7,000. And that's the taxable benefit. So purchase furniture benefited her 7,000. Now we'll add all of this: 7, 3,000, 3,500, 1,300, 500, 1,200, 700, 4,000, and that will give us 21,200. That's it. So very careful with this calculation when the employee received the furniture as a gift or purchase it. So we need to make sure you remember that. This is very common in the exam. All right, let's move on to the next one. The next one we have here, it says Selina is employed by JKL Limited. She gives you with the following information about the money she has received from her employer, an expenditure that she has incurred in relation to her employment. Okay, so you have annual salary 30,000, reimbursed business expense of 600, HMO says agreed dispensation. Okay, employee contribution 8% of the salary to the company occupational pension scheme, membership of a professional body 150 paid by Selina, membership of fitness club 300 paid by Selina. She often used the club to meet the new client, £50 donation to charity, 1,500 expenditure on smart clothes to wear in the client meeting. Now remember that the question asking like the allowable expenses, the salary of course 30,000, we write it down first. Now we need to see which expense is allowable. Any reimbursed expense, remember that it is not allowable. So if the employee take any money back because she spent for some reason, and if she get the reimbursement is a cash benefit, so it will never be allowable expenditure. Remember that. So it will be always 0. So it's not allowable. Reimbursed 600 is a taxable benefit. Then pension contribution, of course, if you make a pension contribution on the occupational pension scheme, remember that will reduce her taxable income. So that is a allowable expense. So 8% on the salary. So 30,000 is the salary. Multiply 8%. 2,400 will reduce the salary. Allowable expense. Professional body membership 150 is always any professional body membership expense is allowable expense. For example, if you paid to your AAT, if you paid for the ACCA or ICW or CIMA, that's all our professional body and it's allowable expense. Fitness club, no, it is not. Fitness club is not allowable expense. Then donation, yes, donation is the allowable expense. So £50 a month, 50 multiply 12, 600. Clothing, no, clothing is not a allowable expense. So from 30,000 we can deduct 2,400, 150 and 600. So our employment income will be 26,850. All right, let's move to the next one. The next one we have here. So Dave earned 20,000 a year in his employment with BCD PLC and also receive a dividend income of 6,300 from the company. Okay, indicate the maximum pension contribution that Dave can make on which he can obtain the tax relief. Remember that the maximum pension contribution is basically the higher of between 3,600 and the earning Now here the earning is 20,000, so that means it will be 20,000. So between these two, we need to pick the higher one. Which one is bigger? So 20,000 actually. Remember that dividend is not a earning. Dividend is part of the return from the investment. Dividend is part of the profit. Dividend cannot be the part of the earning. The earning means the salary, the bonus, this sort of thing. But the dividend is never part of the earning. Alright, the next one says Zara worked for KJ Limited. She incurred the following traveling expense. Travel from home travel from her home in Preston to her workplace in Manchester. So qualifying expense, remember that this is not qualifying because that's the permanent. You can only claim, you can only have allowable expense if it is temporary. Travel to meet the client, so that's the business purpose. Yes, this is allowable expense. Travel from her home in Preston to a temporary workplace in Birmingham, temporary for 18 months. Yes, this is also allowable. So if it is temporary, you are allowable. But remember that if it is a permanent place, if you go every day work from your home, and if this is your permanent place to work, this is not allowable expense. So we have only two. 1800 plus 300 is 2100. The next one we have here is says, show how the payroll deduction scheme work. Now payroll deduction scheme work very simple way. So we do the employer deduct contribute after the income tax. Now we don't do that because contribution always deduct before, not after, because we get the tax relief on that. Employer deduct tax, basic tax from the contribution, and employer get higher relief, basic band. Now we don't do that. Employer deduct contribution before calculating income tax PA. That's the true one. That's the right one. If you remember, like on your pay slip, so if you look at your pay slip, for example, so pay slip, on the left hand side is the gross pay. Let's say your gross pay is £1,000, and if you give the pension, so what happened? The pension is deducted from this 1,000. So let's say pension contribution. So let's say you put on pension 100. So minus 100. So your gross pay will be 9,000. That means the PAYE, the tax, and the NIC will be calculated on 900, not 1,000 anymore. So this is deducted before the PAYE, before calculating the income tax and under PAYE, and you get the tax relief for that. All right, so let's have a look. So I think this is the end of our question. So the next one we have for the property income. So let's quickly have a look, few questions from the property, and then we'll maybe stop here today. So the first one, it says Simran rent out a furnished house from 1st of July. The rent is 500 per month, paid on the first day of each month. That means, remember that when you have April, 5th of April, that means 5th of April is like we already get the rent for the April because everyone paid 1st of April. So very careful when you do the calculation, and you always need to do with the cash basis. If the total rental income is less than 150,000 a year, then you always use cash basis. Cash basis means when actually the money received from the customer, or when we actually paid for the expense. So we don't do the accrual basis. 500 per month, so you need to see how many months. So from the July, so July, August, September, October, November, December, January, February, March, and April. So 10 months. So 10 months, July to April, 10 month, 500 per month. So we do 500 per month multiply 10. So this is 5,000. Then we do all the expenses. So we have electricity 1200, electricity paid 1st July to 31st March, so during the tax year, so we take it 1200. And then water paid July to March during the tax year, water 500. And then insurance paid 1st July to June 24, even though I paid after the tax year, but when I paid, so that's the question. So they said she paid the cost during the 23-24. If I paid, remember that doesn't matter for how long I paid, is a cash basis, I'll take everything. So insurance 360, and the replacement furniture, as long as I paid purchase on August, so during this tax year, replacement 400. So 5000 minus 1200 minus 500 minus 360 minus 400, 2540. All right, then the next one. So number 2 says Julie received the following property income during the year. Annual rent, so per year 6300 from the furnished holiday letting, and late on 6th of August. Remember, that doesn't matter when it is started, because if they said annual, you take the full amount. If it is a monthly, then you multiply with a month. If the question mentioned annual, don't do anything. During the tax year, Julie spent 420 for the replacement and allowable expense 600. The tenant is responsible for paying the water and the council tax. Okay, 3500 from renting out her garage in London parking. So we need to add that as well. So we have the property one, that is 6300, and parking 3500. Both we need to add. Remember that parking also like part of garage, also part of the rental income. Then we need to minus allowable expenses, so 420 and minus 660. So that will give me 8720. All right. The next one we have here is this year Sally makes a property income loss 5000 on letting out red roofs, and the property income profit 3000, and another property Green Acres. Neither property is qualifying for holiday accommodation. Sally also employment income 20,000. Okay, so basically she have two property, so one making the loss and one making the profit. So fair enough. So we need to find the difference for that. So Sally can obtain the loss relief. So this 5000, first we need to offset with this one. So 5000 loss I have, minus I'm going to offset 3000 profit, so I'll have a loss 2000 left. And this one I can carry forward, but I have to offset only from the future property income. Remember that. I cannot use it against my employment income. I cannot use it against my trading profit. The property income relief has to be done from the property profit in future. So we said this one, setting loss of 5000 first against the 3000, and the 2000 will be property income in the following tax year if we have a profit. All right, so I think we can stop here today. So on the next session I'm going to start from the question number 4 where we stopped today. So hopefully, like, if you practice, that will be definitely helpful for your revision. And if you need this PDF question, if you like to print it out, feel free to email me. I'll send you over by email. Thank you very much.